Welcome back, ladies and gentlemen. So today's video will be another interesting video. If you've not subscribed to the channel, consider subscribing because it will be fire. Now in today's video, I want to talk about compression. As you can see, compression is just all about supply and demand. It's a setup and a very powerful setup, and it can help you to pay your bills and can make you a lot of money. Now, a lot of you are wondering what compression is now. For instance, you can see from this graphic depiction, I want to explain it graphically so that from there we can dive into the charts. Now, initially the market was trading to the upside, then it reversed, breaking these short-term lows. Whenever the market broke these short-term lows, at least it signaled potential sell. Now look how the market was retracing back. This kind of formation whereby it was retracing but inside a tight consolidating channel. So this retracement with this tight consolidating channel is what we call the compression. It was compressing just like a spring. You can imagine of a spring. So the retracement inside this consolidating channel is what we call the compression. So the compression is always a very good setup. It's always a nice PA, how the price approach a significant supply level or demand level. Now I want to share for the sell setup, and also I'll flip the chart, or I'll invert the scale so that you can be able to see the buy setup, because it is just the same, just flipping. Now whenever you see the market give you this kind of formation, at least in a tight consolidating channel, it is a nice compression because it is compressing inside a nice consolidating channel. The idea is that it is gathering more energy, whenever it compresses, because the movement that will happen here will eventually be an explosive move. So this is one of the ways at least you can be able to anticipate huge moves in the marketplace. Whenever you see the market at least moving in such compression, so in a tight consolidating channel, it is trying to gather more energy so that whenever it moves out of the compression zone, at least it will move more impulsively. Now the idea of compression, at least it always tries to form some sort of demand levels. At this point, this was a demand level, the market retested it at this particular level. It always tries to consume these demand levels. So the demand being consumed, so this one is also a demand level where the market bought from. Also this one is a demand level that the market bought from, etc. So at least it tries to consume every demand level, but not a must. The market is not perfect. There is no perfect setup. So the idea is that it tries, before it continues moving to the upside for this scenario, at least it will try to consume these demand levels. These demand levels, at least it buys from them. So it always strives to at least consume the demand level. Now your main area of concentration is the demand that marked the initial move. At least where the compressive move began from, at least should be a point of concentration, because it will form our safest take profit number one. Now whenever the market was moving to the upside, until a significant, maybe a higher time frame point of interest whereby it reversed from, let us assume that the market reversed from a significant point of supply at this particular level. Let's assume there was a supply level at this particular point on our left. So whenever market reached at that particular point and reversed, whenever you see the break of this short-term lows, at least it signals potential selling, at least potential selling entering the marketplace. So whenever this low has been taken out, at least a break of structure, whenever you've seen this break of structure, at least it is informing you that the market is indeed planning to take a reversal in the marketplace. So the up move is over. We are concentrating on the down move. So but the market now gave a very good retracement, you know, in form of compression, and I've told you how it do form. Then whenever the market reach a significant point of supply level, you take your sales from. It can either be a supply level with in line with the QML setup, and the QML setup, at least we talked about it, and it is in the video. I'll link the video in this one so that you can be able to watch. So the QML setup. So it can either reverse from that place or rather any supply level, so long as it is a significant supply level where price can reverse from. Now whenever you sell at that point, any supply level, at least the market you've analyzed and you are convinced that indeed it is not a must for it to reverse in line with the supply level that is in line with the QM setup. No. So long as you've done analysis and you're convinced indeed this is a supply level that the market will reverse from, you can take an aggressive entry, but for the sake of it, at least be conservative. At least you're trying to conserve your capital. Now whenever the market reverses from that particular supply level, you see that the move will always, most of the times, will be aggressive and a strong impulsive move, you know, because the market initially gathered more energy at least to try to move out of it. So the market will move aggressively. Your safest take profit. Most of the times it will always reach the demand level that at least formed the move. So the idea, ICT traders can argue that indeed the market formed some sort of trendline liquidity, but there were a lot of liquidity that were residing in this trendline because the retail traders were trying to buy on the bounce of the trendline. So it is a trap zone for the retail traders, whereby there is a lot of liquidity. They were anticipating the market to reverse from this particular point, but what happened? The market continued slamming down, but after reacting to a significant supply level. So you must be very, very careful with this type of setup, you know, and it pays. So you just assume indeed if the market reached a higher point of interest whereby it reversed from, you can be able to take entries whenever this type of setup do form. So it is a very, very nice setup. Now for the buys, let us just flip or invert the scale so that you can be able to see for the buys. Now for the buys, let me use now for the demand, we use blue. So I'll just shift this to this particular place. So this is the sub. Now we shift these colors to pink for supply. Let's shift to supply, pink. So this is demand now. Demand. Then you buy here. Let me now change the arrow so that now the case is true for demand. Maybe the market was in a downtrend, then it reached a significant point of demand now, whereby the market showed a willingness to reverse now to the upside. So the market, whenever it broke this short-term high, at least it signaled that indeed bulls are taking shape in the market now, at least anticipating bullishness in the market place. So what happened? The market now moved in some sort of compression. You can also call it complex pullback. Then it reached a significant point of demand now. You buy, the market will move aggressively, you know, then it will always consume this initial supply level. For the case of buys, at least the market, you anticipate the market to reach at that particular place. So it is a very, very nice setup. At least you can help you to at least stack your orders and you take your buys, and it can also help you. All said and done, let us dive into the chart so that you can be able to see. For both cases. Now this was also compression. The market was moving in some sort of complex pullback, you know, this compression. and the market reached a significant point of supply. Let us use this one, in as much as it was huge, but I'll teach you how to refine your entries. Maybe if you dive into the 30 minutes time frame, you can be able to see it better. So guys, remember to subscribe in this video because it is fire. Now you can be able to see that indeed there was some sort of supply here. This is the kissing candles that we talked about in the other video. You can see we marked the midpoint in as much as the market tapped into it several times, because we have this wick, this body. So you mark this midpoint of it, but at some point, being that we allow at least some volatility spikes in as much as, yes, at least if you could have entered this particular point, supply, we use pink, then you sell whenever the market tapped into it. There are somewhere here, so you just put a stop loss of a few pips above the high for this case. Now the market, at least your first profit, take profit at least, should be the demand that formed the beginning of the compression, and the market reached into it perfectly. So this is a fine setup, it can help you to get your trades. Let us look for other setups. Let us look for other setups. So not much, there is nothing much in this pair, the GBP card. There is nothing much. Then it applies in any time frame. It applies in any time frame. Let us look at another pair. For both the buys and the sells. So the first example is all about this is another example how the market was moving. You can see the market formed some sort of compression at this particular point, then the market reversed at this particular level of supply, maybe this one, this supply level. Now, another thing I failed to tell you, at least the best setups do occur whenever there is a fake out. At least it has taken out liquidity. Fake out is the same as liquidity. It took out the liquidity that was residing above this short-term high. So there was liquidity of which the market took the liquidity before reversing. Safest take profit, I said, at least the demand that formed the initial move, this is the first take profit. If you're evident, at least confident enough, you could, depending on the structure, you could have held more. The market gave you a lot of pips for this particular pair. So it moved in some sort of compression into a significant supply level after the market showed a willingness of breaking structure of reversal. So at least you must have a framework whereby the market is either supposed to sell or to buy. See? There is also this one. The market dived. Maybe this one is the kissing candle. I told you the body doesn't matter. This is the midpoint of it. These two candles, the midpoint. You mark the midpoint all the way to the upper wick. You can see it was inside the supply level. After the market gave us this type of compression, safest take profit, the demand that marked the move. You see this demand. So you could have entered this particular level, stop loss just a few pips above it, then you first take profit at this particular point, because the market had showed a willingness by breaking this short-term lows to move down. You see? So basically, ladies and gentlemen, just try to backtest. Just try to backtest, because it works in any pair, any asset class there is out there, you know, and it won't stop. It won't stop. It won't stop. So just try to backtest and see where it works better. So hopefully it has been an enticing one. Have a lovely night.